Hello, everyone. The first video in this series is about banking institutions. In order to understand personal finance, it is important to get a basic foundation in the types of institutions, the roles they play, and which institution is best suited for a specific activity. A financial institution is a company or institution that deals with financial and monetary transactions. There are two types of financial institutions: banking institutions and non-banking institutions. The basic difference between the two is that non-banking institutions are not allowed to issue checks or demand drafts like banking institutions. There are five types of financial institutions. There are central banks, commercial banks, internet/digital banks, credit unions, and savings and loan associations. A central bank is a financial institution that has control over the production and distribution of money and credit in a country. An example of this is the Federal Reserve Bank in the US. There are six main functions of a central bank. Bank of issue. The central bank is in charge of regulating the amount of money being circulated in an economy. The quantity of money needs to be controlled in order to reach a country's economic objectives and to make sure the economy is stable and healthy. The easiest way to increase the amount circulated is to print more money. However, printing more money can lead to inflation, hence it isn't the most preferred method for banks. Increasing and decreasing the reserve requirement is one of the most common ways to influence the amount of money in an economy at a given time. The central bank requires all depository banks to reserve a certain amount of funds compared to the amount of money deposited by clients. This requirement makes sure a fixed amount of money is always kept and never circulated into the economy. Advisors to other banks. Central banks are allowed to control and advise commercial banks. For example, the central bank sets and mandates the reserve requirement, which every commercial bank follows. The main goal for advising commercial banks is to make sure the bank's performance is at maximum as well as good cash management. Economic policies. Central banks play the role of an advisor when governments make economic policies. They keep the bank accounts and balances of the government after transactions are made. As mentioned before, central banks are in charge of the amount of money circulated in an economy with which the macroeconomic and microeconomic objectives should be reached. It's important for central banks to advise governments when making these economic policies in order to make sure they can properly regulate the amount of money in the economy. Lenders to banks. In a case of emergency and as a last resort, central banks are allowed to lend funds to commercial banks. The amount lent is usually used to cover short-term needs. However, this rarely happens as commercial banks always have an amount of money reserved. The rate at which a country's central bank lends money to commercial banks is called repo rate. Supervisors of other banks. Other than acting as advisors to commercial banks, central banks also act as supervisors. They conduct performance reviews in order to make sure banks are managing cash properly, following rules and regulations, and contributing towards reaching the macro and microeconomic policies of a country. Credit control. Credit control is a function performed by central banks through which the amount of credit given to a customer by commercial banks is regulated. Also, credit is only given to borrowers who are able to repay the amount borrowed. A commercial bank is a financial institution that accepts deposits from the general public and gives loans for investment purposes. An example of a commercial bank is the State Bank of India. Only financial institutions that accept deposits and give loans are called commercial banks. The rate of interest offered by banks to depositors is called the borrowing rate, and the rate of interest at which banks give loans is called the lending rate. Commercial banks make profits by charging high rates of interest from borrowers and paying lower rates of interest to depositors. For example, the rate of interest on a home loan from the State Bank of India is around 6.8% to 7.5%. The rate of interest to open a FD for up to 2 years is only 5%. There are two primary functions of a commercial bank. The first one is to accept deposits, and the second one is to give loans and advancements. There are three main types of deposits. Current account. Current deposits can be withdrawn at any time depending on the balance in the account. For example, if there is a balance of $100 in the account, then $80 can be withdrawn from the account. However, more than $100 can't be withdrawn from the account. Savings account. Savings accounts are payable on demand and withdrawable through check. Whenever the customer wants to withdraw money, they are allowed to through check. However, the banks place a restriction on how many times they can withdraw money from the account. Fixed account. Fixed account deposits cannot be accessed for a period of time. The period of time is specified by the bank. There are three main types of loans. Demand loan. A demand loan is a loan that must be repaid fully whenever the lender demands. The borrower must pay back the loaned amount plus interest on the loan in full when demanded. Short-term loan. Short-term loans are loans paid back in either one installment or multiple installments over a short period of time. The amount of the installment is decided upon by the lender, depending on the amount loaned and the amount of time given to pay back the loan. Cash credit. This is a short-term loan that allows borrowers to withdraw money in order to meet their working capital needs without keeping a cash credit. This is offered by banks to self-employed customers and businesses only. Secondary functions of a commercial bank. Overdraft facility. Customers can overdraw money from their account up to an agreed limit from the bank. This is a type of long-term loan. For example, if a customer has $80 in their account, they can withdraw $100 from their account if the bank permits using the overdraft facility. Transfer and collection of funds. Banks are allowed to transfer and collect funds on behalf of the customer. For example, if a customer wanted to transfer funds from one bank to another or from one account to another, banks could do this with the customer's permission. Purchase and sales of funds. Banks are allowed to purchase and sell funds on behalf of the customer. Buying and selling securities, such as Disney stocks, are examples of buying funds. Letter of reference. Banks can offer information about the economic position of a customer if the customer permits. Letter of references can be used when customers apply for loans. Through the letter of reference, banks will know if the customer has good credit, will be able to pay back the loan, and the amount of balance in the customer's account. Locker facility. Each customer of a bank is given a locker to keep important objects or documents in safe custody. Foreign currency. Commercial banks can also purchase and sell foreign currency. This allows foreign trade to take place. If a customer wants to travel to another country, the bank will buy the local currency or any major currency and sell the currency of the country the customer is traveling to. A digital bank is an online bank where banking services are delivered over the internet. It is a combination of online banking and mobile banking. An example of digital banking is Paytm. Digital banking is a combination of online banking and mobile banking. Online banking allows customers to access banking features and services via a bank's website on a computer or laptop, while mobile banking allows customers to access banking features via an app on devices such as smartphones or tablets. Online banks provide the same degree of security as brick-and-mortar banks in order to prevent hacking. Antivirus and anti-malware protection are used to help detect and prevent viruses. In addition, firewalls, cookies, automatic logout functions, and multi-factor authentication measures are enabled on the sites to make sure hacking is prevented. Banks partner with financial institutions to ensure funds are insured. Zelle is a US-based digital payments network that partnered with the Bank of America. Bank of America wanted to make sure it was easy for customers to send, receive, and request money through mobile banking and hence partnered with Zelle. Other than sending, receiving, and requesting money, Online banking allows customers to perform most banking features online and after bank hours. Customers can view transactions, check an account's balance, pay bills, apply for loans, apply for credit cards, receive fraud detection notifications, etc., etc. Brick and mortar banks also offer online banking. For example, State of Bank India offers online banking as well. It isn't necessary for separate digital payment companies to be established for the purpose of online banking. A credit union is a financial cooperative that provides banking services to its members and employees. American First Credit Union is an example of a credit union. Credit unions are created, owned, and managed by its members. They can be formed by large corporations, organizations, or other entities for employees and members. They are not-for-profit enterprises, hence they don't enjoy a tax-exempt status. The only tax they are exempt from paying is the corporate income tax on their earnings. Credit unions offer the same services and products as traditional banks, however they don't offer as many options. Comparatively though, credit unions have access to better rates and ATM locations. Since credit unions are classified as not-for-profit enterprises, they don't have to make a profit. They only have to make enough to continue daily operations. There are very few brick-and-mortar locations for credit unions compared to traditional banks. A savings and loans association is a financial institution that provides banking services through offering multiple savings options and mortgage loan services. LBC Development Bank is an example of a savings and loans association. Savings and loans associations qualify as depository institutions. A depository institution is an institution that can hold securities and can assist in the trade of them. These institutions are owned by a group of working class members. The members pool their money together in order to help finance their mortgages. The government passed the Federal Home Loan Bank Act in order to fund savings and loan associations. Only 20% of their assets can be loaned as commercial loans, and at least 65% of their assets have to be lent as mortgages. Due to the changing needs of customers, S&L associations also offer many products and services which are offered by commercial banks and credit unions. Key takeaways. Commercial banks and credit unions are the most commonly used type of institutions by individuals for their regular banking needs. Central banks control production and distribution of money and credit. A commercial bank accepts deposits and gives loans. Digital and mobile banking options exist for convenience. Current savings and fixed deposits offer options to save money, and demand loan, short-term loan, and cash credit provide options to borrow money. Savings and loan associations primarily offer mortgages, loans, and other saving deposit options. Thank you for watching, and I hope this has been an informative video. In the description box below, there is a link for a Quizlet which will help test you on the different types of financial institutions. Comment down below if you have any suggestions or questions, and click the like and subscribe button. See you next time.